Good afternoon, everyone, and welcome to the FX panel on the FIX EMEA Trading Conference this afternoon. I'm Stéphane Malrait. I'm the Global Head of Market Structure and Innovation at ING Bank for the financial market business. And I'm joined today with four panelists. John Estrada, who is the Global Head of EFX at Credit Suisse. Pennesi, Head of Quant and Strategy for Spot FX and Commodities at HSBC, Paul Clarke, Head of the FX Venue at Refinitiv, and Jonathan Healey, who is Head of eCommerce at BBVA. Before we start this panel, I would like to remind you a few housekeeping points. First one, this panel will be under Chatham House rules, so everything we say, you can if you like it, you can reuse it, but you cannot use the name of the person who spoke about it unless they give you permission to do it. We are going also to take questions during this panel meeting, and you can enter the question in the Q&A section with your comment, and we'll reply to them as much as we can during the call. Also, please continue to join other panels. There is two other panels after ours to finish the day of the FIX EMEA conference. So the first point we are going to focus today is around FX volatility. As you know, this was an incredible year, and with a big jump in volatility in FX in early part of this year, and then it kind of dried out during the summer. So maybe I'll start with John Estrada. John, what are your views on the FX volatility that we see now? Will it come back? Any views?
Yeah, thank you, Stéphane. It's a super interesting subject, and I think you said something which probably isn't true. I think a lot of people have forgotten the vol. Vol doesn't stick in your mind so long. So, you know, in March and April, you would see people in the industry, that's all they could talk about was the markets, you know, they'd never been so volatile. And now, like you said, a sleepy summer, I think most people have forgotten. I do think there'll be another vol event. I think with the US election or Brexit or trade talks between the US and China, it's going to happen again. And the good news is the feedback we've gotten from our clients is it generally was okay. So they were happy with our service. I mean, you know, most people didn't appreciate the levels of volatility, but we kind of did the right thing. And it sounded like it was true with other LPs. You know, our clients were generally happy, both on the principal side, which I am, and also on our algo side. And again, I think it's street-wide. So I think we did a good job as an industry. When it comes back, we'll be more prepared. You know, a little practice helps a lot. So, you know, we got one down. The second one should be even easier. One thing we've heard from a lot of clients is they're looking to change things. And usually that starts with more communication with their LPs. And so to anybody in the audience, if you're not talking to your LPs, I mean, if you're happy, if everything's perfect, I guess you don't have to do it. But generally, clients are very interested. And I'm not even sure they're going to change something, but they want to open up lines of communication. So I'd recommend you do that. So when it comes back, you're better prepared.
Okay, before we get the view of the others, we can start. We have a poll questions that will appear on your screen where you can get your views on volatility, when FX volatility will come back. And so you can go to the poll section and you can see if it will go. Anyone else has views on the volatility? Maybe Paris?
Yeah, no, absolutely. I think I fully agree with John. I think the volatility was quite high in obviously March and April, and it was for a very long time that we haven't seen that in FX and across markets in general. and there is we would expect to have another event in the coming months, but the good thing is that the electronic trading system that have evolved so much in the past few years that never experienced such level of volatility, and they coped reasonably well, I think, both across the principal liquidity and the algo point of view. Another point to make, perhaps, I mean, recently there have been some comments around the fact that volatility in FX will be driven also by market activity that were previously in bonds moving to FX. So I think that might be another driver of market activity, you know, that we will need to, you know, cope with and, you know, maybe.
Great, thank you, Paris. Paul or John, any views?
I think it's kind of interesting about the fact that the markets have been so quiet, and it's reminding me a little bit of, I guess years ago we'd see big events in EM every few years, and each time it came around, it was something that let's get ready for. So it feels like, although it's been so quiet for so long, some of the volatility hasn't been historically that high. It's just that we just have these events that come around every so often. I mean, I agree that there's certainly going to be volatility coming back, whether or not it's Brexit or the US election. The one thing that we see from looking at the data is there's definitely some differences by currency pair in terms of how they're behaving in these stress situations. So I think that's one of the things that may happen when we see more volatility coming back, is it may impact certain currencies differently to others. And certainly that's something that we see happening more, is that difference across different pairs.
Great, thank you, Paul. And John, viewers think the volatility will come back in the next 4 weeks before the US election. Do you agree with that?
Well, I mean, look, the volatility will come back. That much I know. I mean, that's for sure. I'm just not sure when. I think the thing that's clear is there is a possibility it will come back before the US election. There's a possibility it will come back before Brexit, but I don't think it will come back in anything like the same way, because what we saw in March was kind of unexpected. There will be some vol ahead of the US election. There'll be some vol ahead of Brexit, depending on which way this thing actually ends up going. But they are, people are ready for it. People have got a view one way or another. They know what to do if there's no deal. They know what to do if there is a deal. I think there's probably a little bit of uncertainty about what on earth is going to happen if Trump is re-elected. But, in the end, they are scenarios that people are prepared for. I think what happened in March is people weren't prepared for that scenario. They weren't ready for it. They weren't expecting it. And it was exacerbated by the fact that, we were having to go into a lockdown scenario. And just echoing one of the things that John said, the industry coped very well, and I think incredibly well, when you consider we were all rushing around some of us were rushing around trying to figure out, how do I get this PC up and running in my house? How do I get to the trading systems I need to see? Are they working properly? Getting the engineering guys to work on it to get the performance levels up that were required. And all that was happening at the time that the markets were, as we would say, kicking off. I think it was a really incredible response from the industry. It could have been, when you think what could have happened, it could have been quite serious. The great thing, obviously, I think, is that it has pushed more to the electronic trading platforms. Although, there was a period when that wasn't the case, when the volatility, I think, was at its highest. I think there was probably the usual return to voice to some extent. More so in other asset classes, incidentally, I would say. But is vol coming back? Absolutely. But I don't think to the extent that we saw in March, unless we see, another unexpected event of a similar size and nature.
Yeah, FX is quite electronic, and we saw quite a lot of flash crash. So now we are used to big movement in a way.
Yes.
It's true that what we saw as well was increase in algorithmic trading usage from banks, but also from clients. And the question will be, do you think it's going to stay, or was there any change in the practice of using algorithmic trading? And maybe Paris, do you have any view on that?
Yeah, no, absolutely. I think that was a very good test for algo trading or algo execution that in FX, started like more of a peripheral method of execution a few years ago. Now it's becoming more and more central, even though still not representing a smaller part of the overall execution. So that has been a very good test because client on the increasing on the spreads, justified by the increase in volatility, they saw that the trade-off between the algo fee, maybe I take on the market risk and I'll give a go to the algo. So that probably pushed some of the flow that would have been otherwise traded on principal liquidity on algo trading, and I think the experience has been good in the sense that the performance were reasonable, were they perhaps above expectation. So that I think has shown two things. Has shown that from a provider point of view, the banks providing algo invested quite a bit to making the algo more adaptive, in a sense, smarter to adapt to changes in volatility and the liquidity conditions. And then in the other end, give more confidence for certain users to embed even more this method of execution in their toolkit. So I see that it will stick. So probably the usage already came back to what it was, at peak in March or so, but I think it stays above the previous level.
I think we launched a second poll question as well around the usage of algorithmic trading. Do you think it was a temporary, or do you think it's going to stay? And 80% of the people think it's a market structure change that will stay. And John, Estrada, do you agree with that?
So just to keep the panel interesting, I'm going to start disagreeing with everything that everyone says. So I'll start with a poll, which is always silly to disagree. But from my discussions with clients, I'm principal, I'm electronic, but clients I've talked to dealt in many different ways. And basically the clients who are happy with a certain type of execution became happier with it. And so the people who are using algos, came back and they said the algos work great. And the people who like electronic principal trading said, you guys were super. And the people who go to voice did it. And so I don't see a big change. I think people are just more confident in their choices, which is good. Another thing which I said, and John seconded, which I'll disagree with, even myself, is, I think we on the banks and the platforms, we think we did a good job because we've got good feedback. But if anybody in the audience, any clients think, I was let down, if you haven't told your LP that, you're doing yourself a disservice. You should be complaining about things that you're not happy with. And I'm sure other people on the panel would also appreciate the feedback. It was practice and we can improve. And so, if there's something you didn't like, if you're unhappy with principle, you'd rather do an algo or vice versa, tell the person you're working with, whether it's myself or somebody else, because that'll make it better.
Good point. Or you can raise a question in the Q&A and John can answer it.
Well, maybe not that quick.
Some people said because they use algorithm because the spread was too wide, and that was probably a better way to capture that spread or to be in the trade at a better price. Paul, do you have any views on that, or did you see any change of behavior in the platforms?
Some of the feedback and some of the things that we observed on FSall was that we saw a big increase, obviously, in the volumes. One of the things that we saw was that clients moved. We saw a switch, certainly in terms of the ratio of volumes, from more passive type algos to aggressive ones, where certainly our interpretation of that and the feedback we had from clients was they just wanted to make sure they get executed. They wanted to make sure that they got the volume they wanted to get done, and hence they were doing that by aggressing across venues and with their providers, rather than the passive ones where there was, they just want to make sure that they got filled. So we certainly saw that switch to aggressive rather than passive. And also we got feedback from clients that, especially because they were working from home. So the efficiency of if they were trading a different way before, or maybe this is slightly at odds with what John said, was, by using an algo, it meant it was easier and they knew they could get filled. So if there were challenges working from home, an algo was a simple way of getting that done. So certainly that's the feedback that we had. And to the early point that Paris made, we've seen volumes of algos still higher than against the previous year, not as high as they were in March, but certainly we've seen an uptake still from the previous year.
And Jonathan, Healey, you cannot agree with anybody else. What's your view?
Well, yeah, no, I was desperately trying to find something to disagree with. I think the thing about algorithmic execution is, much like any other form of technology that's underused, is it's all about adoption, and particularly with algos, they're essentially a leap of faith for people to take. You're, trading on a principal basis is nice and cozy. I transfer the risk on an immediate basis, and the thing's done. Yeah, okay, maybe it wasn't the spread that I wanted, but I've got it away, and I've got certainty instantaneously. And that's what's great about principal trading. On the other hand, when you're asking someone to execute an algo, you are taking risk essentially, which you are not taking in a principal model. And so there's a kind of a leap of faith about this. Is that, am I actually going to end up with a better fill than I would have done if I'd have just called BBVA and done the trade with them straight away? So I think there is an issue around this where once it's done and you see that it works, then it sticks. And it goes back to what John was saying. People that were doing it before are going to carry on doing it. What I think is going to drive further adoption is exactly this point in time. People were pushed into using it when they weren't using it before because they felt that they needed to try and get a better spread. That got them over that inertia, took them over that hump, and now they've tried trading in that way. They've seen the results, and I think inevitably they'll stick. Now, as John said as well, it doesn't work for everybody, so there'll be a bit of a drop off. But you can see that the adoption will go higher than it was before, drop off, and in the way Paris was saying, end up higher than it was before, but probably not as high as it initially got in the burst of adoption. So I think it's going to stay. What I don't think, though, I think maybe that's where it stays at a sort of plateau for a while until the next event causes more people to use it, whatever that might be.
Great, thank you, Jonathan. So to increase the heat of this debate, we cannot have an FX panel without talking about last look, right? And last look was a big subject in the last 3 years in the FX industry, but I didn't hear as much about last look disclosure or usage pattern this year. Is it because it's dying of its importance, or people are used to last look or don't want last look anymore? Maybe we'll start with you, Jonathan Healey. What are your views on last look?
Well, look,
as a high point, or
well, I think there has been a lot of focus in previous years, largely due to a lot of high profile. How can I put it? Well, I can only use this word: abuse of last look, and I think that's what really brought the subject to the fore. And so I don't think it's over, and further misuse will result in further discussions and problems. But I think it's always worth thinking about why last look exists, right? And it exists because there are things that you need to check if that's the way that you're trading. If I was to quote the Global Code of Conduct, it would be, I'm checking for risk factors, I am checking the validity of the transaction, so on and so forth. There are reasons why last look is used. The issue becomes a problem when people misuse it. And on the subject of disclosures are problematic, I think, in many cases, because there are different types of clients. Not all clients are the same. Not all market participants are the same. They don't want to access liquidity in the same way. And there is probably a conversation that needs to be had between the market taker and the market maker as to how they're going to trade and what they want to see and how they want things to work. And in fact, sorry to sound like a stuck record, but the Global Code of Conduct actually points to that in the text of Principle 17 and says it encourages a dialogue before and after to make sure things are working as the two parties will expect. So, my sense is that it's sort of become a slightly more sophisticated discussion between market makers and market takers, not in all cases. And, as kind of a regional player, where we're a market taker in some currencies and a market maker in other currencies, we kind of see it from both sides. And, I can tell you that we have conversations with clients when we need to explain things. And I can absolutely tell you that our liquidity providers call us whenever there's any kind of problem whatsoever. And, my view of this is I think the world is moving to a sort of position where as a taker of liquidity, be that on the sell side or on the buy side, if you have the right analytics in place, and I'm not trying to, I appreciate I'm sitting in Pete Eggleston's seat. I'm not trying to push his product, but the analytics that you have are, I think, a much better tool than looking at a set of disclosures. You can gain much more, I think, from understanding your market impact when you execute. You can understand a lot more about what firms are doing when they're rejecting your trades by actually looking at the data. I can't speak for Best X. I have no idea whether it's a good tool or not for that particular exercise. But tools like that, I think, are important. Either develop them yourself or use somebody else's to understand what's happening between you and your LP and vice versa. And as John mentioned, right in a couple of points ago, have that conversation with your liquidity provider or your liquidity taker and work out what works for you both. And I think if it doesn't, vote with your feet, as an old respected colleague on the buy side used to say. It's I think becoming a more mature conversation in a lot of ways. There's a lot of people that are new to looking at it in this way. So there's a mixture of reasons why it's calmed down. Largely, I think because, and I hope that a lot of the misuse is now disappearing. The using of information in the last little window and so on and so forth, which is ably described in the Global Code, which anyone at the ACI will happily give you a copy. Those kind of practices, I think, are now becoming common, and I think that is partly why there's less noise around the subject.
Thank you, Jonathan. And in fact, we sent the third poll about using less look, and 47% of the people think it is still useful and should continue to exist. 40% don't bother me too much, and only 13%, 13% say no, it should be banned. So yeah, maybe not as what it used to be. And is it because the behavior has changed? I want to talk about the behavior using less look or not. Maybe John Estrada, what is your view? Do you believe the behavior now is better?
It's hard to say. So first off, Jonathan's answers were terrible. I couldn't find anything to disagree with. I was just looking for ammunition. So terrible answer, Jonathan. But it does feel better. But of course I'd say it because I'm a market maker. So I think it's better, but it's hard to say. Like, did I know there were problems before? Not to the level that came out later. One thing I'll say is that I'm also doing treasuries. I'm an FX trader, but I started doing treasuries, and treasuries more of a firm market. I still like the FX model better. If clients don't want to have last look, we'll provide firm liquidity, and very few actually ask for that. And rates is kind of the inverse. Most of it's firm, and there's a little bit last look. And I see disadvantages that the rates market have because they have a different model. And, it's only been 6 months, so maybe I'll see the positive in rates. But right now, I think it's a good setup. If clients can opt out of it, we're probably over-communicative. I think everyone's updated their disclosure docs. So I think we're in a good place. But again, if anyone in the audience disagrees, let's hear it.
Paul, you may have some clients in your platforms who are against last look. No, do you see a change in behavior as well from them, or are they still trying to argue last look should?
I think you obviously hear different views from clients in different forums. Obviously, we don't get in the middle of conversations between the takers and the liquidity providers on our platforms, so we never really get involved in those conversations. Certainly, we had a one of the reasons, there are lots of reasons why we did it, but we know that one of the reasons that we, for example, speeded up the data on matching, and that helps providers make sure that they can price clients quickly, and also, potentially reduces any reasons to have a longer hold time. I think most of our clients, the feedback we get is that they're pretty happy in terms of that conversation with their liquidity provider. So yeah, we tend not to get too much in the middle of those conversations. We just get feedback around wanting to see, I think, really what John said, which is analytics is key. I think together with having the visibility and understanding that with discussion with the liquidity provider, if you've got the data and the analytics so you can study it, I think that's made a huge change in terms of how people perceive last look, and then how they can manage their relationships with their providers.
Paris, anything you can disagree with the other panelists on last look?
Well, I don't know if you disagree, but I say from my point of view, I think the optimal holding is zero, right? As a liquidity provider. So I mean, you have to have last look for credit checks, operational checks, because the way that the liquidity is distributed in FX, which is not in a centralized exchange. So you need to have those checks, otherwise, you are going to end up offering double liquidity to everyone. But so the only reason why you will be rejected is because you missed the quote. The liquidity is gone, someone else took it. So for that, but that is still possible if you have a zero holding time, which I think that's what my view is where the optimized should be. Other than that, ultimately, I think Jonathan was perfectly right in saying that analytics is the key, and transparency. So because there is this, so that will demystify a lot of the discussions. So the issue may be that on the buy side in particular, the ability to access granular data and more sophisticated analytics it comes to a cost, and then maybe a lot of clients don't have the skills or the skill to have it. So they either trust their provider or a third party company that provides those kind of analytics to improve the discussion.
Great. Thanks all for your open feedback on this one. The other point where we should talk about, and Jonathan opened that debate as well, is the use of the FX global code in FX. It started 3 years ago. We are now in the 3-year review process. It will be good to have your view about the impact that the global code of conduct has in FX, but let's focus on the electronic world. Did you see it make change or not? And maybe we'll start with Paul on that point.
Sure. I mean, I think the codes had a big effect on all participants that are trading electronically. If you think about the principles around execution, around the information sharing, around risk management and ethics, all of them have got an impact on electronic trading. And so I think the code obviously caused a huge amount of work, huge amount of effort from participants on all sides of the market in terms of analysing their own practices, their own systems. I think we've all been involved and spent a lot of hours a few years ago doing all the work to prepare for the code. There's been obviously a lot of work in terms of disclosures that we've already talked about with management of client orders. And a lot of the clients that I talk to, clearly have been doing reviews about, for example, the venues that they want to hedge on and managing how they want to do their hedging to make sure that they're consistent with the code. Thinking about their risk management systems to make sure that they're reliable and meeting the requirements, and also processes and monitoring. So I think a lot of firms have had to invest in making sure that they're continuing to monitor that their processes and their systems are meeting all the principles. So I think it's had a huge impact. And I think something that we've touched on a couple of times already is data analytics. And there was obviously a trend in terms of data and analytics becoming more important anyway, but the code of conduct has certainly accelerated that and contributed to people caring even more so about those things, because obviously using data analytics is one of the ways that clients can share information and show how they're trading. So I think the code's had a big impact in the amount of transparency that people are needing in terms of their market impact and all those sorts of things. And then I think outside of just purely the electronic systems, the code has helped in terms of communication between participants. So one of the things that we looked at, for example, was during the crisis back in particularly late February and March. And I think that, obviously we've talked about the fact that there was a huge amount of there was high volatility, but also an unprecedented situation with people working from home. And certainly our view was that the code helped in terms of people understanding the market conditions. The disclosures and transparency meant that people understood better what was going on and the pressures on liquidity providers. And so it made it easier, especially with data and analytics, to be able to make decisions about how to trade. And then there were obviously things like the Global FX Committee and the whole market being very aware of end of March and making sure that clients were prepared and planning for how they were going to execute ahead of the end of March, rather than just having a mad day. I think that the market did pretty well in terms of warning clients how to prepare, and then hence all that was electronic, but making sure that we didn't end up in a situation where there was one day with lots and lots of volume. So I think that there's been the impact has been huge, and a lot of time and effort on a lot of people's behalf as well.
The code is not perfect, and for disclosure, I'm working or vice chairing one of the subgroup on algorithmic trading, because the existing code is quite silent of the rapid pace of change we have in the FX market. So probably a question for the others, like if you have a magic wand, what you will change in the code, or what you think are area of improvement that people should focus on. I don't know if anyone wants to start on that.
I'll jump in. I'll volunteer. So I guess one of the things that, so I'll disagree. A lot of people keep saying, the data and analytics, that's going to solve everyone's problems. I think that's unrealistic. I have a team who does data analytics full time, and it's a lot of work and expensive. And some sophisticated or large scale clients have that. But if I had my own hedge fund, there's no way I could do the projects that I could do in a bank where we have scale. And so I think telling clients like, oh, you have the data, you can figure it out is it's true, but they probably don't have the capacity to do so, and they're probably trying to make money in their core products. So I think that's challenging. And the Global Code of Conduct has all the banks writing disclosure documents. They're all very good. I think ours is the best because I wrote it. But if you read in other banks, it's probably very good. Well, maybe not at the same level, but it's probably pretty good. But it's in a different language. I mean, it's still English, but it's a lot of work for a client to process all these different disclosures. And so in general, I would like to see more uniformity. So, the one that always comes up is reject codes. There should definitely be reject code. Like, reject code CR means credit reject, and reject code LL means last look. Make it easy on clients. And our disclosure documents should be as close or as similar as possible. I mean, I guess we do things different ways, so we have to say things differently, but there should be a common language. So a client could read it, and then maybe we only have an appendix or something where our delta is. And, this is a lot of work on a client. And so, we should be simplifying it. And I think GCC is a good way to do that. So
yeah,
you're on that committee, get it done.
Working group working on it right now, so that's good news. Okay, Paris, any views on that? If you had something,
I mean, maybe I'm not sure who has the best, disclosure written, but apart from that, I agree. I think to find some homogeneity on the way we describe things, almost a tick box. Do you do this? Yes or no? Do you do this? Yes or no? And then maybe expand at the end. Might be useful to cross compare. Across different banks and different providers, that is still a bit of a challenge. Yeah.
John Healey?
Well, look, the first thing I would say is just to John's point. Yeah, absolutely, it's going to be difficult for some clients, but the tools are getting cheaper, and it's better to do something in this space rather than nothing. In terms of because you're going to have to eventually. In terms of the standardization, I think standardization is a good thing to aim for in terms of disclosures. I don't think it's going to be, as was said, possible fully. An answer to the question, has the code had a huge impact? My answer is actually not yet, because not everyone signed up to it. And that, I think, is, if there's one thing I'd like to see, it's more adoption. I think the most, one of the most significant effects it's had is for those people that are uncertain out there who they should trade with, the global code actually does at least give them a reference point to say who's signed up to this code and who is going to do the right thing and behave in the right way. And that's not to say people that haven't signed the code won't behave in the right way, but it is at least an indication of a statement of commitment to do things to that reference point. So in that effect, in that way, it's had a huge effect already, because it has provided that. And in fact, the FCA in the UK has already said that they will use it as a reference when they're looking at cases that are put to them. And so that in itself is, and it's not to say people didn't know what the right thing to do was in the first place, right? But we have seen that there were some people that didn't. And that's why there were all these scandals. Now, I think that the fact is that having that reference point just makes a huge difference, because now you know what's expected of you, and there's nowhere to hide. And I think that in that one case, it definitely has had a significant impact. But in the end, what would I like to see? I'd like to see more adoption, and particularly from the wider community rather than what we've seen so far.
Good point. And I would like to see more training as well. People should make sure they train.
Because as you well know, there are tools available from the ACI that will help with training on this particular item, and you can reach them at any of your ACI representatives. So I would encourage everyone to look into that.
So one thing also, so the code has changed behavior, but we see in parallel the adoption in artificial intelligence arriving to the FX markets through algorithm, and maybe one thing we've not discussed enough, we could try to finish on this subject, is more ethical AI. How do we apply ethic in the way we engage in the FX market when we start to use AI? Maybe Paris, do you have any view on that? Do you start to use AI? Do you see that this can be a challenge sometime?
First of all, the terms AI, it is a bit broad what it is. I think if we talk about the automation of decisions, right, or automation of trading, and we define that as a broad term for AI, then every time that you move an activity towards automation, a big point is going to be trust. Trust from the user, trust from the designer. So is this thing I build going to do the things that I want to, and is the user, can I trust this robot that is trying to service me? So the building trust on those systems is always going to be a challenge. And ultimately, as we saw with the algo, right, the way to build trust is to increase usage, right? The more you use it, you trust a bit, you expand your usage, and then you build on top of that. So in the specific team of ethical AI, which is a broader team, not just for FX or markets, it's more, across the adoption, typically people think about that in terms of maybe bias. If you have an algo that does recruitment, do you introduce bias in your recruitment? So it's down to personal information. So in FX and in markets, you don't really have much of that. So I think my reading is that in addition to those teams when they exist, I think in trading is more about the fact whether the algo that is trying to learn to trade is going to learn some behaviors that are not ethical or illegal. So is my algo if left by himself and given as an only objective make more money, probably is going to learn spoofing, when I'm try to hedge. So then how do you prevent that and how do you control that? So I think those are the themes, and it will always be, and it's going to be a good endeavor and something that we need to think about is what are the constraints that you put around your models, your automation, so that whatever they learn are within the realm of what is accepted. I think that's the way I read ethical AI in our markets.
Yeah, so how do you control that? Because I can see where, for example, a self-learning algorithm will see a client coming back every month, 25th of the month, for the same amount, the same currencies, and say, well, if I want to improve my,
But I mean, is it the same way you control a voice traders, right? How do you control a voice trader doing something with that information? So you have surveillance for voice trading. You need to have live surveillance and monitoring for the algo, and also embed, for the algo is even easier. Even you go live, you can have testing that test for certain things not to happen, right? So I guess there are two things. On one side is to put some testing or constraints that the algo cannot breach before you go live, and then monitoring when it's live. But monitoring when it's live, it's not very dissimilar to what a human trader does. Maybe you can do it more efficiently, but ultimately, the surveillance.
And we have 3 minutes left. Paul, maybe from the platform point of view, you think there is a risk if we introduce AI in FX that the ethic could become an issue?
So I agree with the points that Paris made, that you've got to be careful about those controls around behaviors. I think that we're thinking about how we can use AI and things like machine learning for surveillance. So I think that equally you can use those methodologies for surveillance to look for kind of potential outliers. So I think on the other side, then you can say that there are areas that can be of a benefit as well. So I think it's inevitable that these sorts of things are going to be used. It just needs some care.
Okay, 1 minute for each one. To John, 1 minute each. What's your view on AI and ethical AI?
So it's a 3-minute answer, but I'll shove it down to 1 minute. So we actually have an AI trader that goes out and hedges our book with a neural net. And today it's not so bad to be ethical because, like Paris said, you can just put controls around it. And so, for instance, if it's unethical to buy euro-dollar and then shortly thereafter buy dollar-yen, you can just put a control. But that's today. The problem that's going to happen in 6 to 12 months is we're going to have to take our control layer and make that AI so it becomes better. And then we're going to have a black box and a black box, and that is a problem I don't know how to solve. So again, looking to the audience, if anyone knows how to solve that problem, please tell me, because it's coming very soon, and I don't know how to fix it.
Okay, we have a quick question. Maybe Jonathan, Healey, you can take the last word and reply to this question. Are you concerned about algorithmic market manipulation contribution to market disorder?
Yes.
It's an important.
Yeah, I mean, just to follow up on John's point, which is well made. Yes, you can put controls in place, but learning models will often do things you don't expect. And so therefore, I don't know whether you can control everything. And the point John was making about them putting another AI in front of it to stop, as you say, that's an even bigger problem. So I think the issue of how you build controls for a model that is learning itself and at very high speed, in some cases, it's a problem. The other thing, just very quickly, I think you have to think about what data you're using as an input to that as well, because there are some forms of data that you probably shouldn't be using, particularly when it becomes to, as you alluded to before, customer behavioral data and other data that can cause biases in the system. So I think there's a real issue about what data you're feeding in as inputs as well that needs to be thought through.
Great. Thank you so much, all four of you. I think we're at the end of the session. It's 4 o'clock. I will now pass the baton to Deb Efferman, who is going to tell you about the next step.
First, I'd like to thank everybody for joining the session. And a recording of this session will be available from next Thursday on the platform 30 days after the event. The next session in Stream 1 is ESG is no longer a fringe concept. And the next session in Stream 2 is driving the successful implementation of fixed income consolidated tape. Finally, I urge you to take a look at our sponsors' booths in the virtual exhibit hall and network with other attendees who are in the networking lounge. And don't forget to join the demos. You can find an agenda in the info desk. And we have a competition running. For those who visit all of the sponsor booths in the exhibit hall, will go into a drawing and win a prize. So with that, I'd like to thank the panel and everybody for joining this session, and enjoy the next stream. Thank you.